Hey everybody, we're gonna get started here shortly. Hang tight. Just waiting for the rest of the attendees to join. We'll get started in about 2 minutes. All right, Tom, let's jump in here.
All right, let's go.
Hey everybody, welcome. We have six attendees right now, with more joining on the live stream on YouTube, as well as a bunch who are going to be trickling in as we move forward. We have about 20 attendees scheduled to join, so we're just going to jump in here and they can join as they are ready. In the meantime, I want to introduce Thomas Castelli. Many of you guys know him already. He is a partner at Hall CPA. We've had Tom on twice now, and it has been incredibly illuminating. Most of those topics have been just Q&As. And what we've decided to move forward with is specific topics that Tom can present on, and then following that, a Q&A. Now, we'd like to start that Q&A process after Tom's done with, questions related to the topic that he's presenting. But of course, we'll also open the floor to just general questions about tax as well. And then you could always book a consultation with Tom after the fact if you want to dig into your personal tax situation. There's a lot of things to be excited about in this big, beautiful bill. Maybe some things to not be excited about. I might be surprised as well with Tom's presentation here today. So let's dive in, Tom. Thank you for being here. Very excited to hear what you have to say and all the developments that have happened in the last couple months since we've had you on last.
Yeah, thanks for having me. There's certainly a lot going on with this one big, beautiful bill, and there's some things in here that are going to impact real estate investors and just some other things I'm sure people as individuals want to be aware of as well. So I basically I don't have a presentation for this, but I do have key aspects of the bill kind of outlined a little bit. So I'll just kind of go ahead and get started here with what I believe to be the key aspects of the bill people need to be aware of, and then we can take questions from there. So the first thing is 100% bonus depreciation, which is what many real estate investors have been really excited about. So just kind of a quick recap on bonus depreciation. Basically, when you own real estate, you can deduct a large portion of that real estate in the first year that you acquired the property. That includes things like tangible personal property, that's 5-year property, as they call it, and then 15-year property, which is land improvements, which I know there's a lot of for mobile home park owners. And that type of property could all be right now, excuse me, let me back this up. Under the current law, it's currently 40% bonus depreciation for 2025 as it stands today. So, for example, if you were to have a property and let's just say $100,000 was eligible for bonus depreciation, obviously it could be much larger numbers here, but that means you'd be able to deduct $40,000 today. But with 100% bonus depreciation, you're able to deduct the entire amount that's eligible for bonus depreciation today. And what this bill aims to bring back is they want to bring back 100% bonus depreciation starting for properties that are acquired and placed in service as of January 20th. Okay, that's the inauguration day, 2025, all the way through to the end of 2028. That's what the bill would bring back. And at this point, the bill has already passed the House, and now it's at the Senate. And the Senate, just to let you know where the Senate stands with bonus depreciation, they actually want to make this permanent, right? They don't want it just to last the next 4 years. They want to bring it, they want to make it a permanent provision of the tax code. So the Senate is very much on board with bringing back 100% bonus depreciation and being one of the least expensive aspects of the bill. Everybody who in the world in general is studying this right now strongly believes that this 100% bonus depreciation will come back for these reasons. And I think that will be a big deal for a lot of real estate investors out there. So happy to take some questions on that. But long story short, if a bill does get passed and the Senate's aiming to get this closed, they were talking about July 4th, but now they're saying Labor Day. So Labor Day is obviously in September, so we'll have to wait and see. But I think bonus depreciation is one of the biggest aspects that people have been talking about. Now, there's some other things in the bill that do need to be discussed as well. The first one is, believe it or not, people have not been aware of this. The or it's not gotten enough attention. Prior to the Tax Cuts and Jobs Act of 2017, the tax brackets actually went up to 39 and 39.8%, if I'm not mistaken. Then, if this bill was not passed, it would go back up to 39.8%, would be the highest tax bracket. This bill aims to keep them at 37% being the top tax bracket, which could be a big deal for high income earners. Additionally, the standard deduction, the higher standard deduction that we've been seeing, that's made permanent and actually includes a temporary increase from 2025 to 2028. How that sticks through the Senate, we'll see. Another thing is the SALT cap, so state, local, and property taxes. Currently, if you live in a high income state like New York or other states, you're going to be capped at $10,000 on the amount of state and property taxes that you can deduct against your federal taxes. They actually raised this to $40,000 in the bill currently. So that's a big deal for people who are in those states. There's also something called the QBI deduction, the qualified business income deduction, which is a 20% deduction on your business income. And this also applies to real estate, assuming you have income from real estate and you don't have all losses thanks to depreciation. That was set to actually phase out and be eliminated, but they actually want to bring that from 20% to 23%, which can be nice for everybody out there who's running a business or does have real estate income. Few other things in there that are worthy to note is they do have full expensing of industrial facilities. Now I know this is a mobile home park group, but just letting you guys know that if you ever do build a manufacturing facility, you'll be able to deduct the entire thing, which is quite powerful. There's also going to be made some extensions to the qualified opportunity zone program. So for anybody who knows about qualified opportunity zones, if you invest in these qualified opportunity zones using a qualified opportunity fund, you can invest capital gains, or your investors can invest capital gains into these funds and defer those capital gains, and also the appreciation on the actual investment itself. So say you invested 100,000 and in 10 years it goes to 2 million, for example, is a really successful project, the entire capital gains are eliminated if you hold that investment for at least 10 years. Now, that was also starting to phase out in 2026, but they are going to revamp that. The details are still being worked on. I don't know exactly clear how the Senate will treat that, but that looks like they're going to be making some extensions there. One more thing that I think might be helpful for real estate investors in general and business owners to know is the extension of or the increases in the Section 179 deduction. Section 179 is typically you'll see that more on commercial properties or businesses, but they are increasing the cap from 100 1 point basically 1,250,000 to 2,005,000, and they're going to be increasing the max that's the max you can deduct, and then the max that there's like a threshold where this begins phasing out. They're increasing that to about 4 million. So these are some of the more impactful areas of the bill. One more thing I'll throw out there too is the interest deduction. So if you're doing any syndications, there's something called Section 163J, which limits the amount of interest you can deduct unless you elect to use the ADS depreciation system, which basically disallows you from using bonus depreciation. So they're going to be making some changes to that to make that a little bit more favorable. So in other words, you can deduct more interest. So those are just like the kind of the big highlights of the bill. There's some other things in there like the Trump accounts or the MAGA accounts. So if you're having children, your children would get $1,000 in this account contributed by the government that would grow tax free, and then they can later on take it out and be charged the capital gains rates. So that's nice for anybody who can qualify for that. But I've been asked that many times now, so I'm just putting that out there, what that is. I think those are basically the major provisions of the bill. I think that apply to real estate investors.
Thanks, Tom. And I'm just going to kick off the Q&A here with, I think, a question that can benefit a lot of our new investors who don't really understand how we're going to be able to apply depreciation against, our existing maybe active or passive income. And then, what happens when we go and sell? A lot of people don't understand the depreciation recapture piece and what that means on a go-forward basis. What is the strategy in terms of capturing depreciation and then ensuring that you don't have to then pay those tax bills down the line when you go to sell?
Right, that's a great question. So whenever you buy rental property, including mobile home parks, there's going to be the cost of the improvements on the land are going to be depreciated over a certain period of time. It's typically 27 and a half years for residential structures, 39 years for commercial, and for land improvements, I know there's a lot of land improvements on mobile home parks, that's 15 years. Now, you can depreciate this property. Well, this property is depreciated. You don't have a choice. You have to take it. Now, normally, the depreciation is going to be passive, or the losses generated rather by depreciation are going to be passive. And what does that mean? That means that these losses could typically only offset other passive income. Other passive income is presumably other rental income or income that you have from other businesses where you might have a limited partnership interest in. And that's great, and that can help you reduce your taxes over time as your rental income grows. But the issue there is it doesn't allow you to offset your W-2 income or income that you're generating from a business or portfolio income, things like from stocks, bonds, things like that. So the way to make these losses non-passive and allow them to offset your other forms of income, like your W-2 or your business income, is by basically qualifying as a real estate professional. Now, to qualify as a real estate professional, you need to spend more than 750 hours and more than half your total working time in a real property trade or business. There's 11 real property trades or businesses. One of them is rental activities, and that would apply to mobile home parks too, as well. And that's how you'd be able to take these losses and really use them to offset your income and take substantial tax deduction. So that's how that works. Um, I'll get to the depreciation recapture, and then I think there's a question maybe coming in there. Um, the depreciation recapture. So when you buy a property, you're going to have your cost basis. Your cost basis is essentially your purchase price plus some closing costs. And then as you make improvements to the property, as you renovate the property, it could increase your cost basis. Now, when you take depreciation, you're decreasing your cost basis. The amount of depreciation you took over the time you own the property is called your accumulated depreciation. So give a very simple example here. Let's say you bought $1 million property, and over the course of the time you owned it, you took $300,000 of depreciation. Well, your cost basis is going to be a million. Now the depreciation took us 300,000. Your adjusted cost basis is now $700,000. Now, if you went and sold that property for 1.5 million, your gain is not 1.5 million minus a million your purchase price. It's actually 1.5 million minus the $700,000, which is your adjusted basis. Now, $300,000 of that gain came from depreciation. Now that's going to be considered depreciation recapture. And depreciation recapture is taxed at different rates. The depreciation recapture from straight line depreciation, which is just say that 27 and a half years, just divided, whatever that is, over the amount of years you held it, that's going to be taxed at a max rate of 25%. Okay. And then the depreciation from accelerated depreciation, including bonus depreciation, so all the land improvements that are commonly found on mobile home parks, excuse me, that's taxed up to rates up to that's taxes your ordinary income rates up to 37%. So that's something to keep in mind there. That's what depreciation recapture is and how it's taxed. I'll get into a few quick ways on how to mitigate that because I know that's probably going to be the next question is how do you mitigate that, right? The way you mitigate that is through a 1031 exchange. If you do a 1031 exchange on a property, you're deferring both the capital gains taxes and the depreciation recapture taxes by taking the sales proceeds and using it to buy a bigger or better property, or in some cases, a handful of properties. So that's one way to mitigate it. The other way to mitigate it is what's became known as the lazy 1031 exchange, which actually has nothing to do with the 1031 exchange at all. The way you play that strategy is you would buy another property in the same calendar year, and you use a cost segregation study, which breaks down the components of the property into property that could be bonus depreciated, and you use bonus depreciation to generate losses on this new property, which then offset the gain, including the depreciation recapture on the property you just sold. Those are two of probably the most popular ways to do it, and that's my spiel on depreciation recapture.
Thank you. That was a good spiel. I learned a lot. So, quick question before we move on to, I'm sure, what amounts to a ton of questions with regards to what you just said. I
Mhm.
also want to touch on the carried interest deduction for a lot of us who are syndicating and earning carried interest. Is that something that was included in the bill, or it was going to be taken out of like existing tax law? For those of us who are syndicating and earning income that way, wasn't it taxed at like a lower rate? And I might be speaking out of turn here, but I
Yeah.
would like to know more about that, especially for those of us who are syndicating deals.
Yeah, absolutely. So carried interest is the promote. So like say for example, say you have a deal, you syndicate the deal and you're going to split the proceeds with your investors 70/30 or 7 or 80/20, whatever the case is. That 20% or that 30% that you get is taxed at the long-term capital gains rates. Now, for most businesses, that's if you hold it for at least you need to hold it for at least 3 years, and those provisions were changed under the Tax Cuts and Jobs Act. But for real estate, which is known as Section 1231 property under the tax code, it's actually you don't need to hold it for 3 years. So a nice little kind of workaround. I wouldn't say it's a loophole because it's right there for real estate investors. So there's been talk about that being changed and removed. It's very controversial, and there's always talk about it being removed, and almost every tax bill. But as far as I can tell, it's not in the tax bill. It's just not because if it was, it would be red flag, right, for everybody. But it's not. So there doesn't seem to be any changes being made to that. Will the Senate decide to make any changes to that in there as they kind of go through the bill? It doesn't seem so like it. And to kind of give you a reason why that's probably not going to happen is these laws apply a lot to hedge funds as well. And there's a lot of really rich people in the hedge fund space who are going to make sure that this does not happen. So it does not seem likely that that would happen.
Awesome. That's good to hear for those of us syndicating. I did hear rumors of that milling. I didn't realize it happened in every tax bill. I would like to know, just before we open it up to the floor, what is the probability of this bill as is being passed through the Senate? And what changes do you maybe expect to occur based on like the rumblings that are happening right now?
Yeah. Right now, I would say like we don't know. I think just if you look at the momentum that this current administration has, they tend to be pretty good at getting stuff done and pushing things through. So I think there's a good chance. I'd say there's probably like an 80% chance that the bill passes, maybe even higher than that. Um, how's it passed in its current form? There are a few things that the Senate does not like. So this bill had passed the House. Everything I just mentioned is where the House had passed the bill, and now it's in the Senate for the Senate to make their changes and make their adjustments. The Senate wants to make 100% bonus depreciation permanent. That's one of the things they want to change in the bill. Now it's very favorable for real estate investors because it not just last 4 years, it would be a permanent change to the tax bill, which I would certainly welcome. I think most people would. Um, there's a few other things though that they don't like, or that they might want to continue to change. So hold on, I'm just pulling up that list because I have it written down so I don't forget any of the details here.
Sure. And while Tom's pulling that up, if you guys have any questions, I see Tiernan's hand is raised. Tiernan, if you could just post your question in the group here. Looks like he left or he lowered his hand. Not sure if you have that question, but if you could just post that in the Q&A, and then I'll bring you to the stage to ask it, that'd be great. Anyone else who's listening in and has a question, if you could either post that in the webinar chat or the Q&A, that'd be super helpful. So we just have a queue of people to bring to the stage. Thanks very much. And then we'll let Tom finish the answer to this question and then start taking questions from the group.
Yeah, so some of the other things in there, they don't like the no tax on tips. They don't like that one, so they might remove that. They also don't like the salt cap. They might want to try to remove that salt cap entirely. So we will see if that makes it through the Senate, but I know those are just a few things that they're kind of keeping their eye on right now.
All right, great. Yeah, so the first question we have is, I think it's Gian Stein. I'm going to bring you to the stage, Gian. If you want to go ahead and ask the question live, by all means. If not, I can read your question aloud.
So yeah, my question is if I sell an investment house to invest a mobile home park as LP member, can this investment house still perform 1031 exchange?
Okay, so if I've heard that correctly, you're acquiring. Can you say that first part again?
It sounds like she's an LP, if I'm
Okay.
not
Yeah.
incorrect, Jan,
Okay.
and that you're trying to do a 1031 exchange with the with the returns on that LP investment. Is that correct?
Yes.
Yeah.
Got it.
So as a limited partner, you're unable to execute a 1031 exchange, and the reason for that is within the tax code, it requires you to exchange real property for real property. And as a limited partner, you hold a partnership interest, and the partnership holds the real property. So as a limited partner, unfortunately, you can't do that. Now, what you can do in some cases is if the sponsor decides that they want to do a 1031 exchange for the entire partnership, then sometimes they'll take you along, all the LPs along with them, right? And that's possible. But then you would just be continuing to invest in the next property with them. That's one way it can be done. There's one more way that can be done. I'll mention. I'll be brief with it because it really only makes sense on really expensive properties due to the high legal costs as well as the potential risks. Sorry, and that's called the drop and swap. And that's when the partnership drops the property out of the partnership and into an interest, what's known as a tenant in common. And then all the partners would own a piece of that property as a tenants in common. And when it's a tick, that's what they call it, tick. It would be you would then own an interest in real property. And when the property is sold, you can go ahead and 1031 exchange from there. But I will say that's very rarely executed except for very expensive properties because of just the legal costs and complexities of actually pulling that off. It's not something that's a typical tool that you would use in your tool belt in an average situation, I would say.
Thanks, Tom. I'm going to bring Tiernan to the stage now. His question is, as a mobile home dealer, I'm assuming I don't qualify for real estate professional because manufactured homes are personal property. I think maybe we answered that question previously, but Tom, I'll
Yeah.
let you cover it again. And with the caveat that Tiernan is actually a partner with me, a 50-50 partner. There's no GP LP split or anything like that. So I think he would in his case personally, but let's answer the question generally, and then we can talk about maybe how to differentiate between his dealer activities and his his GP activities.
Yeah, so if he's indeed if he's selling the manufactured homes, which are considered tangible personal property, then you would not be in a real property trader business on that part of the income. And that differs if you're a dealer of real property. If you're a dealer of real property, you would qualify. So that's the kind of the difference there, right? And some mobile home parks, when they're not bolted to the ground, like mobile home parks that are bolted and fixed to the ground, those are usually considered real property. But when they're not, and they're in that manufactured space, and they are considered tangible personal property, and then unfortunately at that point, that would not count towards the real estate professional status. Now, what could count towards the real estate professional status is the actual investment in the mobile home parks themselves. That is then a different story.
Tiernan, you got any follow-ups there?
Yeah, actually, to go back to Jean's question, um, I think you covered going from LP profits to real property via 1031. Now, I think she was asking, but I'm not 100% sure, going from an investment home or property and then 1031ing that into an LP investment. Would that be the same deal? It just would not work?
Yeah. The rules are pretty much the same there. That is still the case because she would just be taking she would be taking the real property interest and trying to put it into a partnership interest where that doesn't work. Now, what some sponsors will allow you to do, and again, this is also for them, usually done in limited circumstances, is in my experience at least, is they could have the LP investments like the LLC or the LP, the limited partnership interest, invest in the property and then have a tick where the property, so where the LP owns one, where the LP, like the actual, all the investors on one part, and then that investor 1031 exchange into the property as well as a tenant in common. Now that can be done, but the reason why a lot of sponsors won't do that unless it's a very large dollar investment is because it limits, long story short, it limits the way they can be compensated on the transaction. They can't accept certain types of fees, and it makes it a lot more of a challenging situation for the sponsor to navigate. So while it is possible using that way I just mentioned, it's often not used.
Okay.
That also has legal fees to it too.
So you'd have to be a GP. Now, like in a 50-50 partnership, obviously you own that real property. What if you have like 10% equity in a company? Would that be considered more of like an LP thing, or would you just be a smaller GP and you could?
Yes. So the only time you're going to own the real property directly would be is if you own that real property in your personal name or through like a single member LLC. Anytime you have an LLC that's taxed as a partnership, um, the partnership is what owns the real property. So the 1031 exchange, you and your partners, you and the 50-50 partner, or you the 10% partner, whatever, you would all have to 1031 exchange as a partnership, if that makes sense. And because the same owner, when you 1031 exchange, the same owner of the original property has to be the same owner of the new property. So the partnership who owns the real property would have to say, okay, like say for example, it's me, you, and Mike, right? We all own it 33% each. Um, if Mike wants a 1031 exchange, you want a 1031 exchange, and I didn't want a 1031 exchange, um, you guys would have to basically buy me out because the partnership where we own the property, that has to 1031 exchange, not us individually. Does that make sense?
Okay, yeah, I got it. Awesome. All right, thank you.
No problem.
I'll follow up with that. Then how do syndicators 1031 and eliminate their depreciation recapture if, there's a bunch of LPs on board? I guess technically they're buying out those LP shares when they pay back the initial proceeds from the investment and then any additional gain. So then, how does that typically work for those syndicators?
Yeah, I mean, in that case, if that's what they wanted to do, they would have to do the 1031 exchange, the partnership. They would do the 1031 exchange, and then they'd have to basically buy out their investors or bring their investors along with them. That's the way that's the way that it would work for them.
Understood. And I know, so like based on what you mentioned, it would have to be that entity, right? So how does an entity that's like, let's give an example, like XYZ entity who sells XYZ property because it's held within XYZ entity. then go and use those proceeds to buy ABC property and defer the depreciation recapture into the future.
So they would sell the property. So they would sell their property. They would have the proceeds held with a qualified intermediary. And then they would during the first 45 days of them selling that property, they have to identify up to three more that they want to purchase, or up to, yeah, there's rules around that too, but up to three. And then they'd go and buy the next property with the money from the QI. That's how they would do it. Now that's typically how it would be done. Now, it's a lot more complicated than that because we need to do numbers and calculations to see how much they would need to buy out and if there'd be taxable boot. But like kind of from a high level perspective, that's what that would look like.
Understood. All right, let's see if there's any other questions here in the chat. Does anybody have any questions before we, continue along here? I can continue to ask questions. I have them for days, but if there's any in the chat from individuals who own real estate, I see Caleb in here, I see Dean here. Oh, we got another question from Tiernan here. What's up, Tiernan?
Yeah. So I think I figured this out in my brain. So GN can't 1031 the gains from her property into an LP investment because the other members of that new investment, they completely had nothing to do with that previous property, and everybody has to be on board with a 1031 for it to work.
No, she wouldn't be able to take first. Okay, so in her situation, okay, she wants to take she owned the property, right? And she wants to 1031 exchange that into an LP. That can't work because it's an LP and because it is because she would be selling her real property and trying to 1031 exchange into a partnership interest, which can't work. What would have to happen is the other LPs don't have to be on board for this part. The sponsors would have to say, okay, great. We want your money to buy this property, or we want to build a relationship with you so you can invest in our other deals later on, like either one of those two scenarios. So we're willing to allow you to invest alongside the LP investors in the same property as a tenant in common, and then she would own a portion of the real property. The rest of the LP investors via the LLC would own the other part of the property. Am I tracking there?
Yeah, I think I understand. Tiernan, do you?
Yeah, so she could do that as long as she has equity in that new property and she's going from real property to real property.
Right. And the sponsors would have to want to facilitate that. Now, in practice, in real world scenarios, I've seen this being explored before. I've seen it being executed too. Is that the sponsors are now limited on how they can be compensated on her investment because there's a revenue proclamation, which is just an IRS ruling that basically disallows them from having a promote, disallows them from having certain types of fees paid out based on profits, which just messes with their compensation structure. So they would really only want to do that if there's a very large dollar amount investor coming in that they need to close the deal, or that they want to build a relationship with that investor for future reasons. So they're willing to accommodate that.
Okay, got it. And to go back to the real estate professional aspect, would owning one small park qualify with the 750 hours annually, or would they kind of call somebody's bluff and be like, wait a minute, it should not take that much time to manage this small?
So with the real estate professionals, there is no property requirement. There are tax court cases where taxpayers have successfully defended or won the tax court case with as little as one property. And I think the two cases that they were successful at least I'm aware of, they were triplexes. So they weren't like these large properties. I think with the mobile home park, you might even have a better chance. It just all comes down to, can you legitimately spend 750 hours in the operations of that property for the year? That's really what it comes down to. And with a small mobile home park, can you? I think that question's subjective. I think it's possible.
Okay, and with the real estate professional thing, forgive me, I don't know too much about it. Is that like an application you actually have to fill in and then you're a certified real estate professional, or it's just a designation when you do your taxes?
Yeah, it's a box. Yeah, it's a box. It's a great question. It's a box you check on your tax return. It's a very easy box to check on your tax return. However, uh, when you check that box, it does increase your audit risk. And if you are audited, you would have to be able to defend that you actually met those requirements. That's typically done with a time log. But yeah, it's not like you don't apply for it, you don't designate it. It's literally just a box you check on the tax return.
Okay. And if you're audited and you don't have a time log, they would basically just remove that real estate professional status and you would kind of just lose that battle and you have to pay whatever a higher rate or more taxes that you would have avoided if you were a real estate professional, but now you have to pay it because you can't prove it.
Pretty much, yes. Long story short, if you're unable to prove that you qualify, then what happens is they would just they would back it out and you'd pay the taxes as if you weren't a real estate professional. But oftentimes, because real estate professionals, there are substantial tax savings there. That often leads to back taxes, so you have to pay the taxes back, and then penalties and interest on top of that for the back taxes that you didn't pay originally.
Tiernan, you're muted if you have a follow-up there. But I will ask a question that is in the group here that Caleb asked, which is there an app that you recommend for managing your reps time?
Yeah, we you could use a spreadsheet. A lot of people use like Google Sheets, but there's an app that I've tested out and had some input on like their development of it, called Reps Log. And it's just Reps Log. You could Google it. It's on like on Android and Apple, and it's pretty good. So yeah, you could use Reps Log. That's what I would recommend if you want like an application like that. If not, you could just use like a regular old boring spreadsheet. That's perfectly acceptable too.
And we also have in the MHP Pros paid community, we have a reps log that you could download into Google Sheets and use. Recently, I also will recommend this software that I've downloaded. It's called MemTime, Memtime. It basically logs like not every keystroke, but every window that you have open on your computer at all times, alongside, if you're in a web browser, what tab you're in, and the name of that tab. And you can actually automate pieces of it. So, like for instance, if I'm in the Brighton Court, that's the name of the investment I just made, the Brighton Court, internal Google Sheet. It's actually going to take the time that was spent in that Google Sheet and automatically log it into my log through I think it's called Clockify, right? It plugs in right there to Clockify. So now you can have basically an automation telling your logs on a regular basis that you were spending XYZ time working on something related to your real estate investment. That also applies to your emails, right? So if you're emailing about Brighton Court and that, the subject includes Brighton Court, it's going to pull that in and automatically log it as time spent for real estate management. So there's a lot of different tools and technologies, outside of just a regular spreadsheet, although that tends to be the best because, it's not MemTime is not going to log the time you spend on site or even on the phone in many cases. So just make sure you use a variety of tools. Don't be like someone I spoke to recently whose name will remain anonymous, who said that they use a random number generator at the end of the year, which I was cracking up about. So that's definitely not defensible, although hilarious. So another question we have here is, if a buyer if a buyer park with three people, can I do a 1031 exchange? I can kind of um, I think I can decode this question, and I kind of have a similar one, so I'll ask it in tandem. So, like if Tiernan and I are partnered on a property, or Gene's partnered on our property with me and Tiernan, and all three of us want to then sell that property, it sounds like from what your previous, answer was that the three of us would have to take the entire gain and or the entire amount and transfer it into a new property together. We couldn't separately identify three properties and take those gains into those three individual properties invested into like as a solo investment on a go forward. Is that correct?
Correct, correct.
Okay.
That is exactly how it works.
All right. So I guess in terms of strategy, if you're planning on syndicating, it sounds like it might be beneficial especially because a lot of your passive investors are not going to be able to take those depreciable losses against their active income, that, it might be beneficial to take those depreciable losses against your own income because you can assign it to yourself, if I'm not mistaken, as the GP. However, in terms of like a 50-50 partnership, would you push people to take that bonus depreciation, given unless they wanted to continue with that partner in the future, they would have to then repay that depreciation recapture, if they don't decide to then 1031 that property into another property alongside that partner?
Yes, like in a 50-50 partnership, if they're not both real estate professionals or if one's not a real estate professional, would it make sense? I think it depends. It depends on what other passive income that you have, and what type of other passive income perhaps the other partner has, if any. And that have to make a determination over there. It's hard to say yes or no. I think if there's no other passive or income or gains that either of you have, chances are it does not make sense to do a cost segregation study and use bonus depreciation, I would say, but you have to take into account other people's circumstances. And we have to remember too that even if you did do a cost segregation study there for whatever reason, that what the other partner, when the property is sold, what the other partner could do is buy another property themselves and use a cost segregation study on that property to generate losses to offset the gain, including depreciation recapture for their portion. So there's not a black and white answer there. It definitely just depends on the circumstances of each of the two partners combined and what makes sense in those scenarios.
Okay, understood. And I think because there are so many questions around depreciation recapture, um, I think it might behoove us on our next call to actually walk through some case studies with regards to this, like whether it's a syndication, a single person investing in a property, or a partnership that doesn't include a GP-LP split, what each of those looks like. And I know, like you said, it's very case dependent and it varies in like with all the variables on additional passive income. But just seeing those case studies play out upon sale, I think would be incredibly beneficial for our viewers on the next call. I'm seeing one more question from Jean. It seems like she's still on this investment house that she has. She says, I sell my investment house to buy a mobile home park with other two people. Can I do a 1031 into this MHP? And I think I'll answer for Thomas there because I think he's covered this effectively. Yes, you can, but you have to make sure that those other two individuals who are part of that property are also 1031ing alongside you. Is that correct, Tom?
Yeah.
Okay. I'm not seeing any additional questions in the chat. Unless there are additional ones, I'll open the floor one last time. Then I think we can close with Tom today. All right, Tom, thank you for your time. I'm not seeing any additional questions. I do want to give you the opportunity to let everyone know what the best way to reach you would be. I think after this call, you guys will all receive an email with a form to fill out if you want to connect with Tom, and utilize his and Hall CPA services. So far, we've had nothing but fantastic reviews about his services. So if you guys, would like to move forward with Hall CPA, I'd highly recommend it. And you can do so through our link for the best rates, as well as, direct connection to Tom and his team via email, so that there's more of a personal connection there and Tom knows who you are. So with that, if there's nothing else, I'll hand it over to Tom to kind of just close out with any last thoughts. And thanks everybody for joining.
Yeah, so I would say that the final thoughts here would be there's with this new big beautiful bill in play and with all the complexities that already exist with the real estate, you definitely want to work with a CPA who understands the space. Doesn't have to be us, but could be. You just want to make sure you're working with a CPA for sure. We do have a podcast out called the Tax Smart REI podcast, which is out on Apple, Spotify, wherever else you can find podcasts, where we do cover a lot of the up and coming changes that are coming up, and we'll continue to cover those, as well as a lot of the other strategies that are available to real estate investors at large. So you could check that out. It's the Tax Smart REI podcast, or if you wanted to contact me, you could go through the link that Michael has, and that would be the best way to do so from there.
Hey,
Thank you, Tom. Tiernan, go ahead.
is there any benefit either with 1031s or with depreciation or any other tax savings to having a stick-built single-family brick and mortar home versus a manufactured home on real property, on land, whether it be permanently affixed or not? Is there any benefit to having an actual structure tax-wise?
Okay, so you're saying a single family home, a regular single family home versus like the mobile home park.
Like a mobile home on land,
A
uh,
mobile
single home, like if you were to live in there or for buying and reselling, and then you can 1031 a manufactured home that way because it is on real property if it's on private land, right?
Yeah, so I see what you're saying. So yeah, I mean, it would be better if, for the purposes if you wanted to 1031 it later on, for it to be permanently affixed to the property so that it is real property. Otherwise, if it's considered personal property, because it's not affixed, you can deduct it using 5-year depreciation, but you'd be subject to potentially recapture if you sold it later on. I don't know if that captures the full essence of your question, but I'm happy to go again if it didn't.
Yeah. I know if it's permanently fixed, the mobile home itself is considered real property now and the land. But even if it's not permanently fixed, you're still selling the land. Maybe the home is personal property still, but you're still selling a property. So you could turn 1031 a mobile home on land not permanently affixed into maybe another mobile home on land or a single family home or some other investment, right?
So you would be able to 1031 exchange the land. There's certain nuances with the amount of personal property that can be transferred in 1031 exchange along with that land. So if they're not permanently affixed, you might have to pay some capital gains taxes on or you might have to pay taxes on the sale of those mobile home parks because there's only a certain amount that you're able to convey that's not real property when you're doing a 1031 exchange.
Okay, so you might miss out on some of the savings, like because maybe they're giving you the benefit of the land, but not the improvements because they're considering the improvements to be personal property.
Right, correct. There's a certain amount that you can convey over a personal property, but it depends if it's a large amount because say there's a lot of mobile home parks that are there, then it might not then you might not be able to then you might have to pay some taxes anyway. Long story short.
Okay, gotcha. Yeah, and just to clarify, I mean like just one individual mobile home on a single lot, a half acre, an acre lot, private land, with a mobile home on it, buying that, fixing it up, reselling it for a profit, and then 1031ing that into another one or some other type of investment.
Yeah, if it was all real property because it's permanently affixed, you'd be in the clear. If it's not all real property, I'm pretty sure the numbers, if I'm not mistaken, I'd have to verify, but I think it's 15% of the value can be personal property. So it depends on how much of the value of that is. And I believe it's 15%. I could be misquoting that there, but
Okay, so you would lose 15% because it's not permanently affixed. Not the other way where 85% you'd have to pay capital gains and only 15% you'd be able to 1031.
well, okay, I guess yeah, I guess let me put it this way. Say you had the land was valued at $100,000 and the sale was $150,000. Um, the land would be conveyed. You 1031 exchange the land, but the only 15% of the other amount of the home would be able to be conveyed in the 1031. And I might be mistaken on that exact number. It's just that's typically how there's a certain basically what I'm trying to say is there's a certain amount that you're able of personal property that you can 1031 did you can defer within a 1031 exchange. When it's over that amount, that's when you might have to pay some taxes. And so it depends on how much of that property, how much the mobile home is being valued in this compared to the entire sale.
Okay, that's very interesting. I'm definitely going to have to look into that further and see. Like, I know it would cost, I don't know, 5, 10,000 to have somebody come out and actually permanently fix it. Maybe more if you're pouring a basement and then up with a crane or what have you. But if there's huge tax savings where now it's real property, you can 1031 the entirety of it instead of only 15%. That could be very beneficial. I guess it would depend on what appraiser you have and what the town values the improvements at and what they value the land at. So it'd probably be on a case per case basis.
Yeah, it would be hard for me to give a blanket black and white answer on that. I just know that when there is personal property there, it is different. The rules there are a little bit different, and that's something that like if you were gonna do that, between the QI and your CPA, they'd be able to help you figure that out. Like if you were to work with us on that, just for example, we would do all the research, have everything ticked and tied out, nice and buttoned up, and here's exactly how it's gonna work for you, and here's how you can maximize it. It's just off the top of my head, I'm just not 100% certain what the exact number is. So,
Awesome. Yeah, I'll have to look into that a little bit further, but thank you.
no problem.
All right, thanks, Thomas. I know we had a couple more questions there after the fact, but appreciate your time. Thanks everybody for joining. This recording will be available if you want to rewatch it and go through all of Tom's takeaways on the big beautiful bill. Next time we'll have another subject that we'll cover first, and then we'll jump into Q&As. I'm hearing a lot of questions on depreciation recapture and 1031, so maybe that's
Yeah.
something we can dive into even
Yeah.
more on the next call.
Yeah, I would be happy to come back with the 1031 exchange next time and say exactly here's like, do my research, make sure I have all the rules, ironed out for this, and then give you guys exactly how it works. So be happy to do that and depreciation recapture at some point.
Absolutely. And thanks so much. Sometimes it is nice to have like a diagram in front of you just to see how it's working for those of us who aren't super tax minded. I think I follow, but I'm very excited to see that presentation next time, Tom. Looking forward to seeing everyone on the next call and in the community. If you want to reach out to Tom again, there should be a link in either the webinar registration on our MHP Pros either free or paid school community within the courses section where you can connect with Tom directly and watch his course on tax strategy, which is fantastic if you haven't watched already. But otherwise,